Okay, sir, we shall go ahead. Secretary of the branch, C.A.G. Vasudeva Murthy, my dear committee colleagues, senior members of the profession, past chairmen of the branch, and all the members present today for this seminar, a very good evening to one. Taxation of charitable organizations. It's been always members are interested into the income tax, GST and other areas, but taxation of charitable organizations are very rarely taken up by few of the members. And this Finance Bill 2020 has taken many of the amendments relating to the registration procedures, and also that all the existing charitable and religious institutions which are registered or approved under the session has to be compulsorily required to switch over to the 12AB for fresh registrations. In order to simplify and compliance of the new and existing charity institutions, they have proposed electronic, previously it used to be the registration and all used to be in the manual, and they have kept it electronically and a unique registration number and all. So today we have with us Akhil Jindal, who has readily accepted our request. We have proposed that we are going to take up this topic. And I would like to thank our PVSP Kumar sir, who has coined you for this topic. He said if he accepts, it's an great advantage to Visakhapatnam branch. So thank you very much, sir, for having you today with us. I think that all the members who have attended this session will get benefit out of your deliberations. I request Treasurer Prashant to introduce the speaker.
Good evening to all the members and speaker and respected chairperson. Income tax, Isa from ICAI. He is a recipient of Delhi Ratan Award in professional category in 2019. He's received since 1992. Dr. Akhil Jindal is a senior partner of Jindal and Co. and works out for the firm's Delhi office. Akhil's areas of experience includes the NPO's CSR. He was the Central Statutory Auditor for Union Bank of India. He has been convener and member of the tax study group of NIRC of Institute of Chartered Accountants of India. He has been regular contributor to the financial journals like Economic Times, Financial Express, and Outlook. He has been associated with the column Money Worries appearing in the Economic Times on Sunday. He has authorized a book, Exemptions for NPOs, and has written various papers on restructuring in bank risk-based audits. He is Vice Chairman, Society of All India Institute of Management Studies and Research. He presented papers in various conferences, seminars, debates on corporate and tax matters and associated with ICAI, NIRC, and thank you very much to take the proceedings.
Thank you, sir, for your introduction. Now I request our speaker to continue with the session, sir.
Thank you very much. Thank you for welcoming me, Chairman Madam Bharti Devi ji, your Vice Chairman S. Mulli Krishna ji, your Secretary Vasudeva Murthy ji, and Treasurer for such a long about me, Shri Prashant Kumar ji. And thank you. Has stayed with me after having that darshan. I mean, with such peace. I still remember that sandalwood and all. It was there on the Lord Vishnu first time. It was really a divine experience. So it is very lucky. Though on a lighter mode, I am missing the wonderful landscape of Vizag. If I themselves this online thing. And definitely charitable trust, as you said, few of the members are there in the charitable trust, but this is a big opportunity. Even last time and wherever my seminar is there, ma'am, this charitable trust, the NPOs, now the word is going over everywhere. If you see, philanthropy is taking big shapes, and this is a big opportunity for all the professional members to get attuned to all the laws. And there had, though the Income Tax Act only have very few pages. If you imagine, Income Tax Act only, I think, more than 10 to 12 section in 30 charitable trusts. Still, every judgments coming on this only, various interpretation. Because of so, it is a very simple. Because when my father used to do it, and when I've started last 26 years back, it is a very simple law, but because of nobody is clear, because of the interpretation, and because as the department is want to really tax it, want to make it more clear. We have seen now, as Madam also said, ATG after 3 to 5 years, and that was there was so much repetitious work, and they said at the assessment we will be able to see that. But now again, the new finance minister, honorable finance minister, has again put it back to the law, and they want to again examine everything every 5 years, that whether it is charitable organization and
Sir,
all the
sorry to interrupt you
existence.
in the middle, sir. Sir, your voice is not getting so,
Yeah,
sir. Some
is
disruption.
it clear, ma'am?
Maybe connectivity is poor, sir.
No, we have a good connection. I have a good
Yes,
connection.
yes.
How's it now? How's it now? There may be
Sir, but in
long
between
waves.
it's getting breakage of the voice.
Okay, maybe
As the Zoom meeting, we could see that iPhone network
long
bandwidth is
waves in
low.
Vizag.
No, in Zoom meeting, it is showing as iPhone network is low, sir. Bandwidth is low.
వైజాగ్ చాప్టర్ చైర్మన్
I'll check, man.
రావట్లేదు.
Just 1 second, 1 second.
Okay, sir.
Hello.
Hello, sir.
Yeah, is the voice better now, ma'am?
Yeah, better, sir. Yeah.
Better. Okay. So we'll go to now directly to the charitable trust or organization. We will keep on referring it to maybe charitable trust, which refers to all the companies in the society also. So as we understand, today we are going to talk about charitable taxation on charitable trust, and I have specifically prepared a presentation which is for the new amendment. But before that, I will try to cover the various initial aspect of the charitable trust and the taxation of the charitable trust, so that whosoever is the younger our members, they will be able to understand it. There can be various type of charitable organization. One is the charitable trust, then we can have a society, and then we can have a section 8 company also. And lately I've been always insisting that charitable trust is the best mode of doing charities, and lately by honorable prime minister also has created only a trust which is known by PM Care Fund. He, instead of choosing instead of the earlier society model, he is also chosen a charitable trust model for this purposes. So maybe in all the three aspects of society or a section 8 company or a trust, I personally feel charitable trust is more liberal. There are less compliances other than the income tax one has to follow, and then one can do a lot of charity which is quite liberal. So these are the three types of organization one has to follow. But dealing with the income tax with charitable trust, there you have a sign handle with care on your forehead, because the charitable trust taxation is very, very fragile. If you just, it is just like a bubble. If you just mishandle it, you can just break it. It is just like a butterfly wings. If you not handle properly, they can just break. So charitable trust, to give you 100% exemption on the income, but any small carelessness on the member's part or the trustee's part can lead to very high taxability. So one has to handle to understand the taxability. Now coming to the concept, what do you exactly mean by charitable trust or a charitable organization or a charitable society? Because there had been so many judgments earlier
Sir, shall I?
under section, we said, which was government note, he said, because we are giving lot of benefit to the various people of the society, so it is, we should also be allowed to be registered in 12AA. Then there was again, and we are a private to be registered as a charitable trust, but are they really? Because we have to take all those cases where you will, it is irrevocable. The first and foremost important thing is it has to be irrevocable, that the money will not come back to the trustees or the persons who have created it. And second, the money could not be distributed, because in a private company or a government company or any other type partnership firm, the money could go back to the owner is for the beneficiary. The trustees are only in the fiduciary capacity. So in a trust, the all the money or the accumulation is for the beneficiary. Who are the beneficiary? Beneficiary are the people who really need educational help, like students, people or relief to the poor, people who will need some medical relief. So the all the funds, accumulated funds, belong to those persons and not to the trustee. So the two most important thing whenever you are examining whether a entity is a charitable or not, whether it will be eligible for a 12-year registration and for a 100% exemption, is that it has to be irrevocable. And we have seen there is a section 115TD where it says that if it is a revocable trust, there can be a taxability on the charitable trust also if it is not properly dissolved or the money does not go to the proper another charitable trust. So these are the two preconditions for determining. Now the things we are going to discuss today, we have what we have in hands: condition for a charitable trust to be entitled under section 11, then the charitable purpose definition 215, which is very important, then computation of income under section 11 and tax liability, and we will also discuss corpus donations 11.1d, application of income 11.1a. We will also discuss accumulation up to 5 years under section 11.2. We will also discuss how the income under section capital gain in charitable trust is tackled. We'll also discuss charitable trust not eligible for exemption, section 13. We'll discuss 80G. We'll discuss something about cancellation of registration, then CSR, some compliances, and also the new amendment. So many now definitions, so many things. What is income? What is general fund? What is corpus fund? What is grandinate? What is FCRA donation? Whether donation can be in cash or kind? Whether we should follow accrual system of accounting or receipt base of accounting? What is the order report we have to give? What is Form 9A? Because earlier there used to be accumulation and we used to find a simple letter with the income tax officer with the return and then we could allow the accumulation. Now there is a new Form 9A. Then there is a Form 10, which everything has to be filed online by digital signature or through an OTP. And if they're all not filed within the due date, then you get a lot of taxation. Last 2 years have been quite worrisome for all the professionals who are holding the trust, because if your return or your audit is not done by the due date, your exemption is forfeited. If your Form 9A is not filed, you are liable to higher tax. If your Form 10 is not filed, you are liable to higher tax. So charitable trust, though very simple in 10 or 12 pages, starting from section 215, starting from section 1023C, starting from section 11, 12, and 13, and there are some sections of 115 BBC about anonymous donation. Then there is another section of 115 TD about accredited income when we are dissolving the trust. So there are very few sections, but because of the various interpretation, definitions, and not so common parlance used by the members, such as corpus, general fund, income, accrual, all this have become quite complexities, and everybody is just wondering whether when they file our income tax return, whether we have to file an ITR 5 or whether we have to file an ITR 7. Nobody is aware whether it is an AOP, whether we can still have a mutual association, whether it is taxable, whether mutual association is it has become so lengthy, so complex, being a simple law. So maybe I will take you to history, because you see, when I initially started and when I learned from my father and my senior who did it for the last 55 years and he has great interest in this. Earlier, the charitable trust was very simple. You only need to have a receipt and payment account. And anything which used to come in as receipt used to be your income. And anything which used to go out of your entity, it used to be the application. Because the trust does not use the word expenses, it uses application, which means that you can still have any money utilized for a capital asset, any money being refund of a loan as application. So any money which comes in as income, any money which is going out as application, and whatever remains was liable to tax if it is above the taxable limit. But then comes various interpretation. Nobody was allowed to claim depreciation, but then because of various, as we have the Income Tax Act, we have also jurisdictional judgment, legislative judgments, which change the ball game altogether. They said now you should treat it equal at par with the business organization, and you should allow depreciation. So even having buying or purchase of fixed assets, you are allowed as application. Even depreciation on fixed comes in is your income, whatever goes out is expenses. And there used to be only receipt based accounting, and there was no accrual system accounting. But then again, investment and 11.5 mode, there used to be a lot of investment in FDRs. And so when bank used to give them interest, they used to deduct TDS. And if they take TDS, you will have to accrue the income in your balance sheet. And if you don't accrue it, then there will be a mismatch. And if there is a mismatch, the income tax and again tax your income on the basis of that, even though you're following receipt system. So then there used to be a lot of complexities on that. So slowly and slowly, and with so many amendments in the law under section 11, 12, 13, and the board have trying to clarify so many things, it has become more and more complicated. So we'll go, we can, ma'am, you can start the original, the number one presentation PPT. Okay, can you share my number one PPT, the earlier one, ma'am? So we will talk about I wanted to, we should share number one PPT, number one, the original one. Yeah, please.
Sharing. Sir, is the screen visible, sir, as I'm sharing? Sir, could you see the screen?
I think it will start in one or two seconds. So we will talk about, because as we are just getting the screen share.
Could you see the screen, sir? I have already shared.
No problem, ma'am. It's just coming. I think it is just loading. You have started the screen sharing, but it will start in a minute, I think. So our Constitution of India like Article 19(1)(c), give rights to all the citizens of India to form association or union. And Article 26 also give freedom to religious affairs. So we can have a charitable trust or a society or Section 8 company under the Constitution of India. So that is the right which comes in from our Constitution. Then we go to the definition of charitable purpose, which is the most important definition, highly debated definition of charitable purpose. One needs to understand it purposefully. Charitable purpose, as defined under Section 215 of the Income Tax Act, there are only 5 or 6 limbs which are there. The first is charitable purpose includes relief of poor. The first one is relief of poor. You see, all the limbs have to be read separately, not in a continuous, but the first limb is relief of poor. What do you mean by relief of poor? That any person who is not able to afford his living, he is not able to feed himself by any standard, then that will be relief of poor. There have been a lot of judgments and lot of debate on this, but then again, there has been I've been always telling that it is stands on the circumstances. Suppose a person is driving on a highway on a BMW or on a Mercedes, and unfortunately he gets an accident. Unfortunately, he gets an accident, and he's stranded on the road. And people come and take him to the hospital and spend money on his care. Then again, it will be again relief for poor, because at that circumstances, he was not able to afford any medical treatment. He was not in that condition. So the first limb is relief of poor. The second limb of charitable purpose is education. And which is given to young education, which is systematic of schooling, is called education. It doesn't have to be just, it has to be approved. Doesn't have to be CBSE approved. It doesn't have to be ISC board, but it has to be education. Even teaching music is, it may be hockey or anything. Yes, ma'am. Now it is visible, ma'am. Now it is visible. The next slide, please. Next slide, ma'am, please. Yes. Next slide is education. We're talking about now. The next slide. Yeah. So we are talking about education. There has been a sole trustee Lok Shiksha Trust versus CIT Supreme Court judgment also. But this education, because most of the education it doesn't say free education. It doesn't say education with fees will not be exempt. It says only education, because in current our Indian country, still lot of people are not literate. Lot of people doesn't have medical leave. So education, just education for fees or without fees, maybe concessional or maybe expensive. But if it is provided, it is still has a charitable character. There have been cases where universities have done a contractual obligation with a trust, which they share the fees, and another trust provide various study material. And normally the AOs were saying that no, this is a contractual services. But then there has been high court judgments that anything to do with the education. There has been a very Supreme Court judgment with regard to Delhi Public School, DPS school, which everyone knows now. It is all over India. So they were giving various societies franchisee of their own school, the own society, DPS society, and they were charging fees. So initially, the assessing officer, the CIT appeal, they said no, because you are doing now, this is a business, you're giving franchisee, you're charging royalty, so this is not education. But then again, the Delhi High Court and the Supreme Court decided in the favor of assessee, saying that if it has to do with education, definitely It may be they are sharing giving the franchisee, but again, nobody is taking the money at home. So this is a charitable activity. So there is a Supreme Court judgment. One can go through that DPS society, that it any way connected with the education. Even there has been a judgment of Delhi High Court where even giving scholarship to students, though even we don't have a proper school, only we are giving scholarships, is also being treated as education. So there has been, every day I see there are more than 10 to 20 judgments on interpretation of relief to poor education. But my understanding, my view since beginning is education in any form, free or chargeable or not free, is still education and is a charitable purpose. First is relief to poor, education, and third is yoga, which was recently added and quite become popular also. So earlier, if any yoga was taught, again, it could have been covered in education also, but because there is a lot of confusion, so specifically, yoga was added in section 215, which says that relief of poor, education, and then yoga. Yoga itself, because it belongs to our ancient history, ancient culture, Indian culture. So specifically, that word yoga has been added. If yoga is taught with fees or without fees, again, it will be a charitable purpose. So any trust formed with that object, it will be a charitable purpose. Then the fourth, very important, is medical relief. Then relief is not restricted to giving free treatment of an extremely poor, but also giving treatment at a concessional or at a price. Though not extremely poor, you cannot afford to pay normal. So there have been a Beach Candy Hospital Trust case, 102 Trust, 98 Bombay. Hospitals like in Delhi, you have got Gangaram Hospital, and there definitely must be other hospitals also. We are still charitable and they are enjoying the exemption under the Income Tax Act. Then the fifth, which is also added, preservation of environment, including watershed, forest and wildlife, and preservation of monuments or places of object of artistic or historic interest. This was also lately added. And as Delhiite, again, winters are coming and we are struggling with this. Maybe Vizag, I don't know, Vizag have very cool weather and they don't have any environmental problem, but they must be having a lot of preservation of monuments or places of historic. So Delhi, we are again struggling, and our own chief minister is trying to curb that. So definitely preservation of environment, including watershed, forest and wildlife, and preservation of monuments or places, again, is a big, any object to our trust deed will be a charitable purpose. And then we have the highly debated and the last one, which is the advancement of any other object of general public utility. What does that mean? That anything which is not covered in the first, second, third, fourth, and the fifth limb, and it is still in the character which any object which benefits the general public. Suppose we are creating a dharamshala. Suppose we are creating a water to be given to the poor, or in the earlier when we used to go to various places of religious. So anything, any kind of any activity which is not covered in the first, second, third, fourth, and fifth will be with the object of general public utility. But the only debate arises when normally we file for registration with the income tax authorities. Instead of allowing us under the first, second, third, fourth, and the fifth limb, they only allow us that you are now covered under the advance any other object of general public utility. But why is that? Because this has been quietly debated. That because there is an addition to this clause which is not there with the first, second, third, and the fourth limb. The provision was added in 2015 with effect from assessment year 2016-17, which read as follows: provided that the advancement of any other object of general public utility shall not be a charitable purpose. You see, so this is the proviso which has been added, and this is only applicable for the sixth limb, provided that the advancement of any other object of general public utility shall not be a charitable purpose if it involves carrying on any of the activity in the nature of trade, commerce, or business, or any activity of rendering any service in relation to any trade, commerce, or business, for a cess, fee, or any other consideration, irrespective of nature of use or application of retention of the income for such activity. So what does it mean? That if we are covered under the sixth activity, and if there anything which we are doing, it involves carrying on any nature of activity or nature of trade, commerce, or business, then the other advancement of any other object of general public utility will not be termed as a charitable purpose. Only exception is that if we are doing some other activity of trade, commerce, or business, then if our receipts from that activity are less than 20%, then we will still retain the character of a charitable purpose. But we have to really give stress on this, the sixth amendment, the sixth limb. If we have to be very careful, even if we are carrying on the first, second, third, and fourth, sometimes there is a confusion that if whether we can carry any business in a charitable trust. So one has to be very clear, a character of a trust or an NPO or organization is not defined by the income it is getting, the income it is earning, not it is defined by the form. It is defined by the activity, by the expenses, by the application it is making. So even though I may be running a business, and for let's suppose I'm running a school, I may be running a bookshop, which may be termed as a business to an extent, which is incidental to my running main object, then again it is allowed and I will not be covered by this provision. But if I am doing any charitable purpose under the sixth limb, then my receipts are more than 20%, then my whole income, not the income from sixth activity, my whole income of that trust will become taxable. So one has to be very careful. The trust is very, very fragile. Any small, though we can get 100% exemption, there will be no tax payable. As you have under section 11 and 12, you got 15% accumulation, you've got 11 to for 5 years of accumulation, and you have got 85% accumulation. But any mishandling can lead to very high taxes. Then again, interest. The income is not excess of income over expenditure. The income is your total receipt. The gross receipt is your income, and it is not excess of income over expenditure. And if there is any violation of section 11 or section 12 or section 13 condition, which are added by section, subsection, explanation, proviso, explanation to those proviso, any of thing which is not followed, you may be liable to a maximum marginal rate of tax. Though there has been some judgment saying that in a particular case, but it is not it is only a tribunal judgment that taxability has to be on excess of income over expenditure and not only gross receipt. But again, there could be a case where the assessing officer can say that since you have violated there are voluntary donation on your income side, there are other income, but because you do not have that charitable purpose character and you've been trying to do charitable activity, I am disallowing all your expenditure, which may be A, B, C, salary or anything, and I will levy tax on your gross receipt. And normally in Delhi, we have seen that they impose on tax on the gross receipt instead of excess of income of expenditure, which is still being debated. So we'll come to that next again. Now, what are the conditions? So now we'll come to section 11, that what are the conditions, what we have to fulfill to have the character of section 11, because all the exemption we are getting is that under section 11. So first and foremost, the object of the trust is charitable purpose as section defined under 250. So whenever we draft our trust deed, the main object, whichever in our trust deed is there or in the society or section 25 company, has to be covered under those six limbs. If there is any object which is not covered under those charitable purposes, then we will not be entitled for the exemption under section 11. Then the trust has to be wholly for charitable purposes. It has to be wholly. It cannot be partial. One can have a charitable trust and a religious trust. We can also allow exemption. We are allowed exemption under section 11 for religious trust also. But we are not allowed deduction under 80G for religious trust. But for charitable religious, under section 11(1)(a), it has to be fully for charitable purposes. There is another section 1023C, which has lot of other subsections, which also covers medical institution, which also covers education institution, which also covers lot of institutions which are financed by the government doing charitable activity. So one can cover under section 1023C also, which has to be notified by the government, or which has to be, if your receipts are less than 1 crore, then under 1023C, Roman 3 AD and AE, you can also claim exemption. But recently, the latest amendment, they have now said you cannot, earlier you could allow to have both the benefit. You can earn either under 1023C or section 11 and 12, whichever is more beneficial. Because there is also one more condition of the corpus fund. In the case of section 11 and 12, the charitable trust used to be, corpus donation used to be totally exempt. Whereas in the case of 1023C, charitable corpus fund was not exempt. So that is the difference also in the latest amendment has been removed now. Even in 1023C, your corpus donation, now they have explained that corpus donation, because being capital donation or being for capital purposes, is now also exempt in 1023C institution also. So now section 11, 12 and 1023 are at par. But now you can only choose one. If you choose to take 1023C, then automatically your section 11 and 12 will become inoperative, or you will not be eligible for benefit. And if you choose 11 and 12, then you will not be notified under section 1023C. Further, to have exemption under section 11, the trust has to be registered under 12A or 12AA. And as we have seen now, there is a new section which is 12AB. And I wonder it can keep on going to, then after 5 years, we'll have 12AC and 12AD, and then we will have, maybe our children will see 12AZ. It will keep on amending and evolving slowly. So currently, it used to be under section 12, then 12A, then 12AA. So you will see more evolution of this also. And then accounts have to be audited. You see the trust account, if your receipt is more than the taxable limit, which is 2,50,000, then trust account has to be audited to claim exemption under section 11. And the registration has not been cancelled under section 12AA and 12AA4, and the trust has not violated any of the conditions. We'll cover those conditions also. Section 13, the unlucky number, where you have not given to any related party, or you have not keep the funds under section 11.5 or the investment mode, then you can also lose under section 11. And lately, now they have added also, you have to file your return within the due date by 139(4)(a), then only the exemption will be allowed. So all these conditions, there are a lot of conditions, many more conditions to come in, which we'll have to discuss, and they will keep on adding those conditions. Then only you will be eligible for section 11 exemptions. So we'll not discuss this before 2015-16. And there has been a lot of discussion, ma'am, also, and to all the members, whether a charitable trust can make profit, whether if a school or a medical institution or a charitable trust is making profit. You see, ultimately a charitable trust will be earning income, lot of income. Which will be the head of the income? The heads of income could be, you will be earning voluntary contribution, which is normally known as donation. You could be earning interest because on FDR or fixed deposit, or you may be making certain investment in various allowed under section 11.5. There are various modes of investments. So you may be earning income on those investments. There could also be income on rental of the property. Suppose you have a property in your trust and which you can give on rent, and you can also give it to a commercial purpose also. It is not that it should be charitable character. Any income you can give it. You can give a shop, a charitable trust can give a particular place to a commercial property, and it can earn rent also. So you can earn rent also, and there can be another type of income also. Membership fee also one can earn. So any kind of income there, whether we can make profit, whether there can be excess of income over expenditure, or whether it has to be that every time we have to make losses only, or we have to really apply 85% and we should not make any profit into the charitable trust. So there has been various Supreme Court judgment, and there was a very important 2015 55 Taxman to 55 Queen Education Society that profit is not a bad word. As our Dr. Manmohan Singh, at that time the Honorable Prime Minister and then Finance Minister, used to say profit is not a bad word. So even for charitable purposes, charitable trust, surplus made by charitable trust, if it is plowed back for those object of the trust, then there the profit, the making income is not uncharitable. They are charitable. So making income, because ultimately it is only because of the financial year. Suppose a trust is making a hospital and it has got a lot of donation and it's got a lot of corpus donation, and it may make 10 years to create an hospital or make 5 years to that facility, and in the meantime if it is having some income and it is not able to spend that money on that purposes because it maybe takes some time for section, then again because our object is charitable, those income again will be exempt, subject to accumulation we'll have to make, subject to all other conditions we are fulfilling. So making profit or having excess of income is not uncharitable. You can still have a charitable character and you can still have a business which is incidental to your main object. Then you can still retain your charitable character and enjoy exemption under section 11. So we have done with the provision of the definition of 215 and section 11. So when coming to section 11, how much exemption and how much application we have to make? Under section 11, if there is receipt, receipts could be including your voluntary donation, your rental income, your interest income, your membership fee. There could be even school is running. You can have various type of even cultural function fees. You can have a seminar fees. You can have a other fees also. So normally 85% of your gross receipt one is to apply to be eligible for a charitable purpose. If you don't apply 85% and if it is 75%, then maybe you have to pay on the balance 10% tax. But then the income tax section 11 allows you to accumulate. If suppose there are interest, there is interest on a fixed deposit which you have not received during the year. So it allows that if you have not received that income during that year, you can file a form 9A saying that I will invest that money when I receive it. I will apply that money, not invest, apply that money. Instead of expenses, that money will be applied only when we receive it. So form 9A can be filed and your accumulation of that income will be allowed. Or you can also, there is another clause which says under section 11.1 that if you can say due to any other reason, when a particular year you are not able to apply that income and you file a form 9A, you can apply in the next assessment year the same income. Then again, you will be able to allow to accumulate that. So these are the two ways. The third way is that you can file under section 11.2, accumulation for 5 years. Suppose I have to make any capital asset. I've been trying to do some school I have to make, or there is a bigger asset I have to purchase, which will benefit. I have to make an old age home. Suppose I have to make a particular hospital has to buy a machine, a particular big machine, let's say a scanner machine or a CT scan machine. So they can accumulate that much money, which they can say we can accumulate and spend in the next 5 years. And in case you do not spend that money in the next 5 years, then what will happen? In the 6th year, after the 5 year, 6th year only, then income will become part of your normal kitty or normal income. So all of it, whatever income is in your kitty has to be applied. And all this 11.2 is also again deemed application under if you're filing a form 10 or form 9A, then again is supposed to be a deemed application. So these are all the benefits. So you can accumulate your money and avoid paying taxes. Only condition is that you will have to invest under section 11.5 modes only. If you take out that money, invest in any other mode other than 11.5, which is like fixed deposit with the nationalized banks, fixed deposit with the scheduled banks, or keeping with bank balances, or keeping in public sector enterprises deposits, or recognized mutual funds which are allowed under section 11.5, then there is no violation. Otherwise, any given to a private party or to any party which is giving high rate of interest will be violation. and the consequence can be that your whole income, your total receipt will be liable to tax. So one has to be very careful. Any violation in any case under the various terms and condition of 11 will lead to higher taxes. And then again, it can spill over to the next year. So normally, if there is a violation in a particular year, the disallowability or taxability will be of that particular year only. And if you're not able to correct it, so next year again, you can claim exemption, but one has to be very careful of your charitable character and the investment of the funds or accumulated funds in those trusts. Then we have got corpus donation under section 11(1)(d). After 11(1)(a), B, 11(a) talks about that 15% application, B and C for property. Then we have got 11(1)(d). 11(1)(d) talks about income in the form of voluntary contributions income in the form of voluntary contribution made with a specific direction that they shall form part of the corpus of the trust or institution. So 11(1)(d), ma'am, corpus fund is totally exempt. It is totally, if there is a, what is corpus donation? It is just not a corpus donation by the trust itself. There has to be a specific mention by the donor. If I'm receiving that, I cannot do it. I cannot put on a receipt saying that this is my corpus donation and this is my general donation. The person who is giving that donation, he has to make voluntary contribution made with a specific direction that they shall form part of the corpus. Then only they are exempt. And we have to be registered with the 12AA registration. There have been certain cases where they say, even though you're not registered under section 12A, and if you receive any corpus donation, they are still exempt. There have been certain cases, but again, it is a matter of debate because corpus means capital receipt, as we understand, we all members understand. But normally, the income tax only accept that corpus donation under section 11(1)(d) is only exempt when there is a specific direction. A letter has to be there written on a paper saying that so such and such money has been given for this specific purpose of the trust, this object of the trust, then only those corpus donation will be exempt. And this is over and above your normal general donations. So this corpus donation forms your part of corpus fund and they directly go to your balance sheet. They will not go to your income and expenditure account. Whereas your voluntary contribution or donation or general donation will go to your income and expenditure account. Corpus donation will form part of your corpus fund and they will directly go to your balance sheet. There can be certain grants, capital grants, which will also form the, if there is a letter from them, from a government, they could also form part of the corpus donation. Sometimes they form, but if they are not utilized, then those have to be returned. So then again, it will be deducted from your corpus donation. So that is 11(1)(d). We discussed about 15% accumulation. We discussed about then another judgment which is very important was whether if there is an excess of expenditure over income, whether we can carry it forward, because the current ITR forms do not allow that. Even there has been various dispute going on for so many years because the ITR form doesn't allow that. Whether like business up to 8 years the carry forward loss is allowed, whether the trust allows that. But now there has been a judgment by Subro's society where it says that if we have a deficit in the previous year, that can be carried forward and it will be allowed as application of the income in the next assessment year. The only way I feel it can be tackled is that because it may not be application for that year, but once the Supreme Court judgment is there under a scrutiny assessment or as a members when we are auditing, there can form as part of the application of that year itself. Suppose if you want to take the benefit against the current year income because there is Supreme Court judgment, so any excess of expenditure over income of any previous years accumulated excess of expenditure or any deficit is there, that can be taken as allowed in the next year. If we are having income, we are not able to apply more than 85%, so we can claim that benefit also in the particular year. Then another income, which is again kitty other than the voluntary contribution and then the interest and the dividend, and is the capital gain. So that is also a lot of confusion among the members, how this 11(1)(a) has to be tackled, how the capital gain income has to be tackled, whether for all those capital gain income, whether indexation is allowed, whether for capital gain income we will be able to reduce the cost, whether capital gain has to be calculated as it is done in the normal way. First, I will have to make you clear that for all kind of income under the charitable trust, where section 11 is applicable, the method of computation is totally different. That is as per section 11. All your income from house property, your income from interest, your income from voluntary contribution, or income from capital, they form of the one kitty. They have to be part of the one kitty, and they have to be dealt in the way it is specified under section 11. For capital gain income, there is a specific condition of 11(1)(a), which says capital gain will only be exempt if the net consideration, that means it does not reduce the cost. It says whatever receipts you receive on sale of that asset, capital asset. Suppose there is a property in a trust and you receive, suppose there is a 1 crore of property in the trust at cost and you receive 2 crores for that. Your gross receipt, your capital gain will be 2 crores for the purpose of section 11, and you will have to apply net consideration, which is 2 crore in another capital asset in the year itself, in the financial itself, to be exempt under section 11(1)(a). So if you purchase another property which is of 2 crore, then there will be no capital gain taxes in the section 11 on a charitable trust. In case you are not able to apply, your capital gain, which is sale proceeds minus your cost, will form part of the main kitty of income. Then again, you can apply 85% towards the various charitable purposes. So that is the how it is done in the charitable trust. 11(1)(a) gives you specific exemption, and there has been a specific circular about the board also. Suppose you're not able to invest in a capital asset. There was a circular number, I think 100, which came in 1975, board circular, that if amount is invested in a fixed deposit for more than 6 months, it will also be treated as capital asset. So if one wants to plan its sale of capital gain, if we can take benefit of those board circular, where it says you invest into the fixed deposit, and fixed deposit also will be termed as capital asset. And incidentally, if you have taken any loan when you were buying the property or any land or any asset during that year, and that loan is also repaid when you sold the asset and you repay that loan, that is also allowed as application toward that capital asset, because we had taken that loan buying that property and now we are returning that. That is also, there are judgment that will be application toward the capital asset. So if one or two condition, similar conditions there, we can take it under section 11(a) as application toward capital asset. Then now we are going to cover, because we have to cover the new amendments also. So I am covering all this section 11, section 12 in brief only. Then we are covering section 13, which talks about the, if there is any violation or when the exemption is denied to the trust. So which are those conditions when this section 13, when it is the exemptions are not allowed. The conditions are when you give loan to a interested party, when the use of immobile property, suppose you have a property or a school and where the trustees are residing, so use of any movable property of the trust property is used by the trustee, then that is also a condition where this will be taken as violation of section 13. Then any payment of excessive salary or remuneration to the trustee or to the office bearer, that can be also taken as violation under section 13. If there is purchase of investment at excessive price, that is also taken as violation of section 13. If there is sale of investment for inadequate consideration, so this can be examined. Then section 13(2)(f), this can also be taken as violation of section 13. And then investment in interested party or substantial interest or not specified in the modes of 11.5 is also violation of section 13. So any of these conditions, if are violating the conditions, then your income, even though you are doing everything correct, your whole income will be liable to tax under the charitable trust under the Income Tax Act. There was a judgment that where refrigerator was kept at a residence of a managing trustee without adequate rent or compensation. And then they said, no, yes, it is a violation. This was Agappa Child Center versus CIT and 226 ITR 2011. And sometimes the fixed deposit, this is a very common phenomena. So many assessing officers find that fixed deposit of the trust are given to the bank and the trustees take a loan in their own firms. So this is also not correct. That will also be violation of section 13. One has to be very careful because now the lien is marked. So there is also similar case in Society for Integrated Development in Urban and Rural Area that certain kind of this also will be attract section 13. So definitely all these kind of benefit should not be taken. If you're doing a charitable trust, all the bylaws of section 11, 12, 13 should be followed strictly. Then excessive remuneration paid to interested party. Now, what is excessive remuneration? Nowadays, so many trustees are educated. They are MBA, they are engineers, they could be highly, they have come from abroad and they form a charitable trust. But even if they want to some remuneration, so we will have to examine whether it is not excessive, whether it is comparable, what they were getting before when they were working for some company. So that it is quite subjective and according to the discretion of AO. And as we are entering into a faceless era, faceless now tax assessment, so it is going to even more difficult, and we have to have a lot of documentation with us to prove that any remuneration paid to related party like a principal who is also a trustee, which in the charitable trust, and he becomes principal of the school, or he is a vice chairman of the school, and if any remuneration he takes, it is not excessive. So we'll have to keep quite documentation, their academic records, their previous earnings also into account to prove that it is not violation of section 13. Then who are those interested party? It is defined under section 13.3, normally author or trustee of the trust, founder of the manager of the institutions, relative of the all the those person trustees, all the relatives they are covered, which is defined, relative is defined under Income Tax Act. Then concern in which aforesaid person have a substantial interest. So all the firms in which trustees or managing trustees or the office bearer are there, all the concern become interested party under section 13.3. So even a manager of a trust could be termed as a related party. So one has to be very careful that any transaction with interested parties or related parties is done. Already there are income tax focus on the related party even in business concern, but specifically in charitable trust, this is highly risky and highly fragile. So one is to follow that. Then we can cover section 80G simultaneously, because under section 12AA registration, 80G is allowed to all those, the benefit is given to the donor. The donor who pays the money to the trust, they are eligible for benefit under section 80G. So normally the 12A in Delhi, normally the 12A registration and 80G registration were done simultaneously. But now after so many from all over India, they got the information. They say first you have to get the 12AA registration, and only after that you will get the 80G once you prove that you are doing real charitable activities. So if you are able to give that evidence while giving that registration that the trust has done so much of evidence to that extent to charitable activity, you will be able to get the 80G certificate also, by which, so the trust doesn't get anything, but the donor will get a 50 to 100% benefit. So income of the trust under the 80G, the donor up to GTI, 10% of his GTI is eligible to get deduction under section 80G, which is 50% of the normal donation. And if they are covered under other 80G or any specified like, so they can get 100% deduction also. Then there used to be a lot of debate about withdrawal of the registrations. There's section 12AA, because if any of the violations, normally any of the violation, any interested party payment, any violation of 11.5, any particular violation was there, the assessing officer or the income tax officer used to deny the exemption in that particular assessment year, but they will also try to make an application, try to a petition to the commissioner, because this cannot be withdrawn by the assessing officer. The withdrawal can only be done by the commissioner of income tax who is granted it. So they used to put a file to the commissioner of income tax that why the registration should not be withdrawn. So now they're trying to even do it regularly, renew the registration with the new amendment, which used to be applicable from 1st June 2020, but it is now been delayed, I think, since 1st of April 2021. Earlier, it was delayed to 1st of October, but now I think they've said now from 1st of April it should be applicable. So withdrawal of registration was again a very contentious issue, and even the assessee used to go to the various high court and writ petition that the registration cannot be withdrawn. But nowadays, the registration certificate comes with lot of condition, like dry cleaner used to give a lot of condition that you have to follow A, B, C, D, E, F, G, H. If any of the condition is not fulfilled, your registration will be withdrawn. But because of lot of dispute, so now they have come with a new section 12AB taking care of all these things, so that the registration, you have initially a provisional registration, then you have a permanent registration, so that the assessee any time the registration can also be smoothly withdrawn if you're not doing the proper charitable activities. Earlier, they were never used to be withdrawal of registration allowed under section 12. So under 12AA, they bought a section for withdrawal of registration also. So maybe we'll try to cover now the new amendments which are there in the last 1 or 2 years. Which there is a separate PPT. You can also start there. Madam, we can go to the second PPT, which talks about the taxation, the new amendments.
Yeah, yes, sir, yes, sir. We'll go. Yes.
Thank you, thank you. So we'll talk about recently, last 2 years, 2.5 years, there have been a lot of amendments. And because the trusts are allowed to even run business enterprises, there has been various judgments, and they are at one particular time, they say the trust has to be only charitable. The law allows you to run even a business for first, second, third, fourth, fifth limb, and you don't have to file a separate report for that. You have to maintain separate books of account for that. So they then again try to keep on plugging those things and trying to revisit those things, so that charitable trust keeps on involving on those charitable equity only. My view on that was that you can earn income, you can even property can have a commercial. There used to be, they bought a direct tax code, and they tried to change a lot of law with regard to the charitable trust. And they were at that time they were talking about that the properties of the trust will not be allowed to be commercially used. But then the direct tax code also fall, and it was not passed. So currently, the properties, immovable properties, can also be used for commercial purposes. You can earn rent, you can have interest income, you can even have a separate incidental business undertaking where you can have those benefits. So we will now see what are those amendments. Like recent 2 very important amendments the income tax have brought is revalidation of existing registration. Even though we had that procedure of earlier, I think more than 15 years back, we used to have that procedure every 3 years, because they allowed you for a 5-year registration of 12A and 80G, but every 5 year or 3 years you went to for a renewal of 80G exemption. Now they have brought it back. Just like the dividend distribution tax on companies, they said dividend will be exempt, then dividend distribution tax will be there. Now again, they have bought dividend income tax on dividend income. Similarly, they've again bought that all the existing trust societies will have to re-register themselves. And the date was 1st June. And the new section 12AB was introduced with effect from 1st June 2020. But unfortunately, because of the corona, it could not go through. There were a lot of problems. We could not follow. The income tax department was extending dates and due dates. So finally, they said instead of 1st June, it should be 1st of October. Then finally, lately by 29th September, the relaxation amendment, there were some amendments. They said from 1st of approval, all those revalidation of existing registration will be done. This again gives a huge opportunity for all the professionals, because all existing trusts in society will have to file online law forms. They will have to specify what kind of activity were they giving, though currently the form has not come out. And they were also an issue, because when we were dealing with the income tax exemption here in Delhi, after 1st June, we had certain applications which were made in January, February, March for 12AA registration. And there was no approval was coming in. So we were speaking to them. They said, we don't know, sir, 12AA registration is already expired. The law has already expired. Now it is no longer valid. And 12AB has come in force from 1st June. But the form is not there. So what should we do? Whether we have to grant registration under 12AA, the old law, or whether we have to grant registration under the new law, whether we can do that. So finally, there was a clarification to the CIT exemption that currently you go on making registration under the old law, under 12AA, till date the new law kicks in, which is now, earlier it was 1st October, now it is 1st April. So up to 31st March, 12AA will continue, which actually by the act which was already withdrawn, and 12AB will kick in from 1st of April. And what does it entail? All the existing charitable and religious institution already registered under 12A, trust and institution registered prior to 1996, 12AA trust institution registered after 1996, section 1023C, and trust registered under 80G will be required to reapply, again apply on an online form, which will be notified now. It is not yet come out to the income tax authorities for new registrations. And if you don't apply, what will happen? If you don't apply, your existing registration will go out. So then you will become liable to tax, and maybe there is again a debatable whether 1115 TD will become also applicable, which is about accredited income, because once you don't have the registration and you are out of that 12AA registration, though it is controversial, it may be that accredited income or your whole accumulated funds in your trust may become liable to tax. So one has to be very careful that you definitely, as soon as it kicks in, as soon as the date from 1st of April, we should keep all our papers ready, all our trust deed and everything, all those existing papers, and apply online for re-registration. The registration under section 12AA means the income tax authorities recognize the trust or institution as an established charitable purpose and therefore exempt from payment of income tax. And 80G also you will have to apply again. The process will be totally online, and this will no physical interpretation like faceless assessment, but you will have to give, because sometimes so many trusts may have undergone change. They may have modified their objects. They may have modified various other amendments into the trust deed. And earlier, 2 years back, there was also an amendment in under section 11. If there is an amendment in the main object or any object which is critical, then within 3 months, you have to apply to the CIT exemption for re-registration or for obtaining registration. Because if there is change in the object, So all this re-registration or revalidation of existing registration may throw up a lot of changes for the assessees, for the trustees, for the members. So we have to be very careful whatever we do. Once the online forms are ready, there will be a window of 3 months within which application must be submitted. And after processing your application, your trust or institution, 12AA or ATG may be revalidated by income tax. They can reject it also because there will be a lot of criteria. They will check with your objects, the previous objects. They will check all about your registration. They will check whether you have filed your income tax returns, whether you have filed proper compliances of 11.5 has been done. So if all those have not been done, you can be thrown out. So this all has to be done. So this is very important re-registration. And as I told you that your accumulated income under section 115 TD, like it can become, the whole income can become definitely taxable, or if they decide, okay, we'll give some more time, at least income for that particular year. Because if you have not applied and they give you a window again for some time that, okay, so many SSCs have not applied and they could not apply because they don't have the full papers. So they may give you window, then at least income for that assessment may become taxable. So one has to be very careful. We may be looking at full income tax on accumulated income under section 115 TD. And once if it is accepted, the application then renewal will be for 5 years or existing trust, and after 5 years and before expiry of 6 months, you will have to again apply for a renewal of 12AA, 12AB registration. So this is the except from the memorandum which had come in for ATG 12A. We have already know about it. We can go through that. I don't have to discuss. Then what about new organization? You see, we were talking about existing organization. Any new trust or society which have been formed during that period, they also 12A will be applied. So newly established trust and institution applying to income tax for registration for the very first time will be given provisional registration, because now they're not saying registration immediately. They're saying it will be a provisional registration which can be withdrawn anytime, and it should be valid for 3 years. And after 3 years again, before 6 months expiry of that provisional registration, you have to apply again. And if you follow all those conditions of your provisional registration, then you will again get a registration for 5 years. So that is a difference. We'll also come to what are the different dates in a later period. Then they have talked about either 12AA or 1023C. Earlier, there used to be, we can have both. We can have a registration under 12AA or 1023, but they say now there can only be one registration. Either you go for notification under 1023C, or you go for registration 12AA AB and have 11 section 11 registration. So we have to be very careful on this front also, that whether we are totally covered under 1023C or either 12. And also definitely this is new compliance under section 80G. For 80G, there will be, you will have to file form just like TDS. Every charitable trust or institution will be required to state as just like a TDS return, all the donation which we are receiving, we have to file, we have to create an online on a portal, on online user ID, and all the donation on a monthly basis we will have to upload. And all the fees, anything which is there above a particular amount, let's say 1,000, those will be uploaded under that user ID. And then again, we will have to issue a certificate, just like a quarterly certificate, we issue a TDS certificate, and all these donation will be reflecting in your 26 AS, the person who's giving donation and the person who is receiving the donation. So there'll be a parallel 360-degree transparency of donor and donee. So, and this will be additional compliances so that there is no backdated donation, and all these statements are filed online on a monthly basis, and certificates are issued. And if these certificates are not issued, just like TDS certificate, there will be a quite high penalty, which may be not less than 10,000 and which may be extended to 1 lakh rupees. So for all those honorary organization, charitable organization, I think it is quite a difficult, onerous task, but as professional brothers, as maybe as honorary, we will have to take this task and follow it, and because there could be huge liability on these issues. Then this is, I've given amendment in section 80G, which are an entity already approved under section 80G shall be required to apply for approval. On doing so, the approval registration notification in respect of entities shall be valid for a period not exceeding. So this is also for 5 years. 80G will be given for 5 years, and similarly, just like 12AA, and fresh application will have to be made. And for 80G, if there is a donation, cash donations above 2000, the trust or the donee is not allowed any benefit of 80G. There has been some misnomer or some confusion that whether a trust can accept cash donations. The only issue is that a person who's giving donation, if he gives donation more than 2000, he will not be able to accept, he will not be able to issue a certificate of 80G certificate that you are allowed to give a 80G benefit. But as a trust, you can accept donation in cash for more than 2000 also. And there can be any other receipt also for more than 2000. But only payment, cash payment, if you make under section like 40 and 40 are now also applicable under section 11, any disallowances. So you make any cash payment, any application above 10,000, then that will not be allowed as application towards charitable purpose. That will be disallowed, and there will be a tax on that. Similarly, on any payment where TDS is applicable, then if you do not deduct TDS, section 40A, 40 will be applicable, and those amounts will also be disallowed, and this will not be allowed as application in your under section 11. So these are on a similar footing in the business taking. Like in business audit, we all understand TDS has to be deducted on all the income. Similarly, for and cash payment above 10,000 cannot be made. Similarly, here also one has to be follow the TDS compliances, and the cash expenses compliances has to be followed. We will just go to 12AB, ma'am. There is a next, after 3-4 slides, there is a section 12AB. 12AB, under the new tax regime, they have defined all these entities under various categories, section A, B, C, and D category. What are those categories? A charitable religious trusts, which are already registered under the existing law, are under A category. Charitable religious trusts whose registration expired under the new provision, they will be B category. Charitable trust institution having provisional registration under new provisions, they are C category, and all other cases we define under D category. So what is the procedure? This I've tried to make a table and chart. It was there in the various rules also, that application has to be made for A categories within 3 months from the commencement of the new provision, which was earlier 1st June, then it changed to 1st October. Now it has gone to 1st April 2021. When order will be passed by the commissioner or principal commissioner will pass the order in writing for 5 years within 6 months. Currently also within 6 months, they have to decide for a registration as soon as you file an application. So that's why application has to be made before, as soon as the new section kicks in, which is 1st April, and then within 6 months they will decide. Income on which new provision apply, assessment year. So if it gives you get your approval within the next financial year, then for the whole assessment year that will be applicable. Even though it is, let's say we get our approval in June or July 2021, it will be applicable for 21-22. Time period in which order shall be passed within 3 months respectively, calculated from the end of the month in which the application was received. So normally they have decided now for initial existing registration within 3 months the CIT will pass an order, and similarly for 80G also the order will be passed. For B category, again at least 6 months prior to the expiry of the registration. So after we obtain the registrations, new registration under 12AA, then we will have to apply, because it will be a 5-year registration. As soon as it is coming to expiry, within 6 months, before expiry of 6 months, we will have to apply. Then all this gives the various dates for B and C and D category. Then when this will be applied, what is the dates when they have to pass an order. So we have to be careful under which category we falls in, and accordingly one has to follow that. Then we'll go to ma'am this previous slide, which is rationalization of the 26 AS. 26 AS will now cover all the kind of donations also, where donations received by the donee and donation given by the donor. In your 26 AS, all this will be covered. And another provision which is also applicable, sometimes which have been a lot of discussion, is 271 AAD with regard to the penalty for fake invoices. This is also not only applicable for business trust and organization. This is also applicable for charitable trust and organization also. And this is already kicked in. This is already kicked in from 1st April 2020. And for various, with my experience, there are various various organizations, because they are handled by the onerous people. So they normally are having kacha bills or improper bills. So if that kind of supports are there, you may advise your trustees, you may advise your societies, may you advise your secondary companies, any kind of invoices which are not proper or kacha invoices, or they can be in for a penalty also for improper invoice or 271 AAD invoice. So this is also had kicked in from 1st of April. So all our professional members should try to handle those things also properly. Then ma'am, there is a last 115 TD, accredited income. In the same slides, we have accredited income. Tax on accredited income, section 115 TD. This talks about this provision for tax on accumulated income of charitable institution in case it merge itself into form on which is not eligible for benefit of 12AA or fail to transfer upon dissolution all its assets to any other charitable institution registered under 12AA. Just like we have a popular case of Escort Hospital, Heart Hospital was there, and it was finding it very difficult to follow the compliances under the charitable trust and society. So then it tried to come out of that. But at that time, section 115 TD was not there. But has it tried to done it now? Then all your accumulated funds and the market value of the property, of immobile property, will be liable to tax at the rate in the tax as defined under section 115 TD. So accredited income, and even there has been controversy going on with effect from 1st April 2020. Any trust which do not get registration under new section 12AB may be liable if the charitable institution does not make application, it choose not to make application, or the application is rejected. Section 115 TD may kick in and they may be liable for. So we have to be very careful that we revalidate our registrations before we can, so that we do not have to pay tax under 155 TD. So this was the major gist, ma'am. So if you want, we can take some questions from the, or any queries you have received from the members, and we can cover it that. There may be certain queries with regard to, because their interpretation is different, like audit, like whether we have to get the audit done up to 2.5 lakhs, whether we have to get tax audit done, whether what is corpus, what is general fund, what is education, any interpretation, whether coaching centers are allowed as charitable organizations, whether, so if there are any queries, have you received any queries on charitable trust before, now we can take on that question for next 15-20 minutes, and then maybe you can take. Thank you very much, all members.
Thank you, sir. Members, if you are having questions, you may unmute yourself and speak to the speaker, sir.
Hello, sir. I have a small question regarding, let's just say, an educational society which just crossed 1 crore of the gross annual receipts in the current year. So which applied for the 1023C6 in the month of April or May or June. So there would be a time, suppose per se the time limit for filing of the return is September 30th. Suppose if we don't get the registration under 1023C6, how do we need to file the return?
But are you registered at 12AA?
No, because it's an educational society. So
okay. So it was an education institution and your receipt was less than 1 crore. So that was already covered, solely existing for education. But if you have applied for, you can still go for that. And once you notified, then it will be covered the whole assessment year. There has been certain cases. So if you get notification done by the concerned authority, prescribed authority, then for the whole assessment year, the benefit will be available. Similarly,
but
the case with regard to
what if the registration is not granted?
Then you will liable to tax, yes, because you will not be notified. Yeah, because that is why normally for tax planning we used to have both the registration 1023C and section 12A registration also. So that in particular case, suppose 1023 is not there, but now they have removed that from 1st April 21. So that will be difficult for you now. But for this is the risk you will have to take. Yes.
So from my experience, the authorities are willing to sanction 12-way registration than 1023C6.
Yes, it is very difficult to get 1023C6.
So I have to just project myself as a trust or a charitable trust and then get a registration than an educational society.
Yeah, because yes, because I feel now, because once they have made both them at parity with regard to the corpus fund. You see, the only difference I can think of between the 1023C and charitable trust 1112 was that you were not supposed to have that corpus fund exemption in 1023C, whereas in section 12AA registration, corpus fund under section 1120 was exempt. Okay. So corpus fund used to be taxable. Corpus donation used to be taxable under section 1023C. So now even 1023 is exempt also. So it is better to have section 11 or 12AA registration.
Okay, so let's just take another scenario where the educational society has crossed the gross annual receipts of 1 crore and they haven't applied for the 1023C6 or the 12-way registration, and they're about to file the return. So from my understanding, they would be filing it as AOP, a normal AOP where the basic slab rates would apply, not under the maximum marginal rate.
See, this is quite a debatable topic with regard to AOP, because what does your deed say, whether you are engaged into charitable society? Because normally AOP or a mutual association, you see, it has to be your object. What is your object? Like all the clubs, there's a mutual society. A mutual society is normally exempt for income tax, even though because all the receipts are from the members. But an AOP then will be liable to tax definitely. And whatever is your and your expenses are for your own object. All expenses are for those purposes only. So those will be normally be allowed as for the earning those income, any income, whatever income you are having, the receipts you are having.
Okay, let me reiterate the question, sir. So it's just the whole context is about the educational institutions. So here the question is about taxation, sir. Whether it has to be taxed at the society hasn't taken registration, hasn't applied for registration at 1023C6, and the current year they have to file the return of income. So they file under, do they have to file under ITR 7 or as an AOP and get a tax audit done?
They will have to file under ITR 5 only or AOP only, because it will not, if you file ITR 7, first it will not accept, because it will say no, you don't have a registration, and then you will become taxable maximum margin rate. It is better to file under normal only, AOP only, as AOP.
And one more thing, sir. Sorry.
No, it's good.
So let's just say after 2 years of this thing, we apply for a 12-way. So won't the question be raised then saying that why haven't you applied earlier?
The law allows you from if you are eligible and you're doing those activities, you're doing charitable activity, but you are not getting those registrations. So once you register, then from that year you will be eligible for exemption. The question will arise, but definitely we'll have to answer those queries also. Yes.
So so if we have applied and our application is rejected, so we can ask for the reasons for rejection and fight with it, sir. File an appeal.
They give you the reasons. Yes, they give you the reason normally. They give an order now, so rejecting your order. They give you the reasons also, that because of this reasons this has been rejected. Definitely, and one can go into the. You see, there are so many, because you have to directly the CIT appeal, because normally it is done by commissioner exemptions.
CIT
so
exemption.
appeal, so CIT exemption. So the appeal lies with only this ITET.
Criminals. Yes. Okay.
Yeah, criminals only. So that will go to the tribunal, and there have been so much favorable orders. So many times the registration has been rejected, and once you go to the tribunal, then it is accepted.
It's again a long process. So,
No, it's not long, but it can be done anyway.
yeah. All right, sir. Thank you. Thank you for that.
Yeah.
Good evening, sir.
Good evening.
So, just we have already discussed that in case of an excess spending in 1 year can be carried forward and claimed as spending in the subsequent year.
Subsequent year, yes.
Yes. So, even though the act is silent, judicial pronouncements are in favor of it.
Now, Supreme Court is again your ultimately the Supro Society case.
Yes.
I think until unless they again amend the law. So
in
on
fact,
the current law, it's yeah.
Much of the law is analyzed only by the courts, not by the act.
Yeah,
especially
that's so much of complexity those who because the courts do not understand what income tax wanted to do. Initially, it was only your registration application, and always our view was till this Delhi High Court and the Supreme Court judgment came, there was no carried forward of the loss. In a year, you receive something, you spend or apply something, and balance is that was like that. Because had the legislature or the initial act wanted to bring that, they have bought that you should have carried forward loss. So instead of this courts interpreting in a different way and this should be allowed, so it has become like depreciation. It has become very complicated now. And now the court says no, Supreme Court says you have to allow deficit also. The act is silent. There is nothing in the act.
Now the income tax return forms, they are deciding the act, because the previous year's excess spending was not given any proper place in the return form.
There is no place here.
Yes, there is no proper place. So especially in the faceless assessment scenario, how that excess can be reflected and brought to the notice of the assessing authority.
Only by, you see, in your own balance sheets and income and expenditure or your computation of income, you have to mention that this is the expenditure of the application which you made in the previous year, which you are applying in the current year also, which you are taking as an application in the current year. As an auditor, because where in your form 10B, there is an application towards charitable purposes. You may have to include the previous year deficit also. That is my view. The only way to deal with it is because currently the income tax return form doesn't have that.
Yes,
so the current application will include previous year deficit as well if you have to claim it.
So even form 10B also not giving any specific place for the brought forward of excess spending. It all speaks about only current year's excess spending. So and because now it's 1 minute, sir. Now it is enclosure-less returns. So everything I have to fit into the boxes given. As you said, the balance sheet, etc. Whatever notes I write, SSE writes, it becomes it doesn't reach the person who has to see this.
It but in the faceless, it will reach. Na? In the faceless, it will reach that person. In faceless, when they will ask for balance sheet, at least that position will be clear.
So once wherever in either the footnote or a notes to accounts, we have to mention all our grounds. Then we have to see. So similarly, similarly, the corpus fund donations were also, even though they are exempted, the return form at the first place says include all the corpus donations, whether it is all donations, whether it is towards corpus or non-corpus. Then it was not giving a place for the exclusion of the corpus fund donation. So by mixing it, automatically it gets taxed.
But up to last year, current year form I have not seen now because there's some changes they are making. Up to last year, if you put corpus fund donation, they were excluded from your normal income. They were not taxed.
No, that is what I faced also, because CPC also giving notices. There was no scope for exclusion of it. The return forward schema is designed in such a way that it is not giving deduction.
Current year or the last year?
Last year, sir. Last year. Current year.
Last year. No. Last year we filed so many corpus fund donations, and they were automatically in the computation. They were exempt.
Then I might have missed
maybe sometimes you see what is happening also. Sometimes the people who are making that software, sometimes that is also issue. They are not properly able to tackle that. So I've seen various vendors, sometimes the ITR 7, because they are not spending so much time on that. So that is also sometimes there is a problem.
Like non-profitable, non-remunerative return forms.
So ITR 7, because very few people are handling, and sometimes the member are also 1 or 2 returns are there. So not much time is spent.
Okay. Right,
like for us, we are sending more than 500 returns for trust. So we are doing day in and day out, we have to tackle that. Like for FCRA, there was latest query we have got. In ITR 7, there is a column for FCRA donation, which brought in from 14-15. Assessment year 14-15 is started. So many cases are coming where people have not mentioned FCRA donation separately. But now that information coming to the income tax officer or by way of from the FCRA department, the Home Ministry.
Yes.
So now they are issuing notices to those trusts, because since you have not shown your FCRA donation, why it should not be taxed fully? Because it is part of your normal donation they have shown. They have not shown it separately. So nowadays, like even the return like 26 years, so many 360-degree it is going on. One has to be careful for filing the return now, because we all members, other side will be troubled like hell because of any mismatch of information.
Yes,
or
yes.
Again text. So even the filing of the ITR is very, very now careful. One has to be careful in which section, which column one has to go in for all those. And ITR 7, because ITR 7 again, if there is a small, like last 2-3 years, it's been a harassment for professionals. Form 9A, they were not allowed even after due date. Audit reports were late, returns were late, 10 was not filed in time. And in Delhi, I can see there are most of the cases they were tax or something or the else. Huge taxes, crores. And everybody was running for post to pillar and for condonation, which only came after 1 year or 2 years. Then the CIT can allow for condonation because board only had that power. So then they designated the CIT could do that. So it came after 2 years. Till that time, everybody has to deposit some tax on behalf of that liability. So one has to be very careful. By the due date, everything has to be done. Which incidentally currently is 30th of October now, 31st of October.
Thank you.
Thank you very much. Thank you.
Sir?
Yes.
This 80G puts a cap on the cash donations made by the donor up to 2,000 rupees. Like, correct. Is there any cap on the donee side also to receive to certain amount, or like it can receive any amount beyond 2,000 also?
It can receive donations. There could be the only offshoot could be anonymous donation, which is a section 115 BBC.
Right.
So if you receive cash, because there is no other law in that ATG, only they say if there is an anonymous donation without the name and the address or identity is not clear, this could be anonymous donation and that will be taxed at 30% straight away. And if a person gives a cash more than 2,000, he will not be allowed ATG benefit definitely. It can be cautioned by the AOs because about 10,000 of all donations, normally if the assessment, they ask for the PAN number and who has given that much of cash. So there could be issue from that point of view. Otherwise, you're allowed to donate this. You can give a 2 lakh of donation, cash donation, but it will still be as normal donation. You can issue a receipt. The person will not get ATG benefit.
Okay, right.
Good evening, sir.
Yes.
In the case of capital gains for a charitable institution, in case I purchase a capital asset out of the corpus funds of the trust.
I'm sorry, you slightly Your voice is slightly slow.
Is that audible now, sir?
Yeah.
That's better. That's better. Yeah.
So in case of a capital gain scenario for a trust, if I acquire a capital asset out of the corpus funds of the trust, and when I sell that capital asset, would it still be subject to 11(1)(a) or can I claim an exemption? Matlab, is there
there is no exemption. You see, how do you know what is corpus or what is general fund? You see, any capital asset owned by the charitable trust and any profit on that will be capital gain. And that capital gain has to be dealt as per section 11(1)(a), which you have to apply, net consideration you have to apply in a new capital asset, which could also be a fixed deposit with a bank, as per the board circular, which currently stands. But if it is not done, then it will form part of your any capital gain. After reducing the cost, it will form your part of their normal income, normal kitty, which will be liable to tax.
Okay, thank you.
Members, while asking the question, if you can on the video, speaker will be able to see you and speak. It will be more interactive while speaking. Yeah. Any other member having any queries?
Anyway, so what I can put in again, another thing is, while filing the ITR 7, because there are optimus, you see, I keep on receiving for the last one, when the online process has been started, various notices, CPC keep on issuing notices because of some small or a big error of our professional members. So we have to be very careful. We have seen demands to the extent of 100 crores, then which has to be tackled and which has to be solved. So, and this is only because of very small, silly errors, I will say. So we have to properly go through that ITR form by column, just like a business form. Normally we don't go, and all those disclosure, wherever we have to put information, we should disclose that. Otherwise, any information like corpus fund mention, we have to mention, trustees details we have to mention, how much, like for 11-2 accumulation for the last 5 years or last whatever accumulation there we have not utilized properly, it has to be mentioned which financial year, because in the ITR it is financial year and not assessment year. So sometimes we confuse it with the assessment year because we are filing the return with assessment year, but that column in the ITR gives you about financial year. So all those information has to be properly then whatever has been applied, what is corpus donations, then whether is there anything applied other than the object of the trust, then can be liable to tax. So we have to be properly ITR 7 we have to fill it, and there are good people like which can go through like the new form, the ITR 7, and go through it and properly fill it. So I think when we all member for doing justification to our job, we should go through that.
Similarly, sir, in case of certain resident welfare associations, normally on mutuality basis, they need not file the returns, like plot owners associations, etc. But because of their corpus invested in some banks as a fixed deposit, they are deducting the TDS. So to get the amount of the TDS, they are forced to submit the returns. Then the question is arriving whether it is certain issues like the maximum marginal rate taxation or the beneficiaries shares determination. Is it determinable or undeterminable? Normally, all these associations, owners are the beneficiaries and their share is undetermined. It is not determined. So invariably, it has to be taxed at maximum marginal rate. So instead of getting the refund of hardly 5,000-6,000, they are visited a demand of another 12,000 rupees.
See, so, normally my experience with this AOPs or concept of mutuality, there are judgments that anything, because as we all understand, we cannot, because all these funds are coming from the members and AOP, so we cannot make income from ourselves. Exactly. So concept of mutuality, there have been a Supreme Court judgment also, Change Road Club and so many other judgment also, a recent judgment also. So there can be no taxation on that. And to that extent, there has been some more judgment saying that even a fixed deposit income is also exempt. There was 2-3 judgments which had gone through. Even to that extent, some judgment has come because it's to be spent on member also. But earlier view which was there, traditional view was there, that if there is any income from source other than the members, that income we should offer for taxation, and we should pay tax on that. So any FDR interest is there, or any other income is there, other like sponsorship income is there. So under the concept of mutuality, those income will be liable to tax. On that, whether we should get benefit of slab rate under AOP. Yes, the first, like AOP and individual, we have that chart also. So AOP should also get the minimum slab rate also. But provided it says any member does not have a taxable income, so then we automatically forfeit, because all members must be having taxable incomes.
Invariably.
Invariably. So when you put in that return form, ITR 5 AOB, then it automatically shows maximum marginal rate. So that changes they have to make in the ITR forms. And like for ITR 7, we have been actively working with the people who were trying to change that. In Delhi, there used to be a person from the board, Mr. Vipul Agarwal. So then he came into exemption. So he made a lot of changes. In the last 2-3 years, we sat with him, and a lot of changes were made in the ITR 7 because of that. So maybe similarly for this also, changes will have to made in the online forms, so that we can have whatever the law states, because this is not as per the law.
So till now, they're all chargeable at MMR rate only.
Yeah, currently, yes. Yeah.
Okay, sir. Thank you.
But all income from members, if there is no FDR interest, it will be totally exempt.
That's fine, but it's not possible because they insist on making some fixed deposits, some bank transactions. Hardly 20-25 flats are there. Each flat maintenance charges are around 2,000 rupees. Invariably, they do it online, bank account, the surplus funds.
My suggestion is, so only on FDR interest you are paying tax, and not only on the member contribution.
No, only FDR.
Or FDR interest only, because what you can do is, you can show the whole contribution coming from the members, part of your balance sheet, saying that it is from the members only. And only FDR interest should be shown under the income and expenditure account.
So that is taxable at MMR only?
MMR only, yes. That can...
Okay, sir. Thank you. Thank you.
So dear member, any more queries?
Any more queries? So make utilize of the opportunity of the speaker, sir. Please to all the questions.
Yeah, of course.